Good morning, traders. Today is January 15th. I got to check. Yeah, January 15th, Sunday. Took a bit for me to get these updated this weekend. Have been busy out here in California with this rain. It's coming down. We need it. Don't take it the wrong way. I love having this extra rain, and just hopefully the mountains and the burn areas don't have any issues. Right now the biggest issue we have is that especially where I'm at, is that it's just dumping harder than normal. So no other major problems. But let's go over the basics. This is the MENT Rotational Modeling System and real estate update. So let's go back over here to the MENT Rotational Modeling System. Try to spread these out a little bit so you get a bigger view. And understand that this is the rotational modeling system on the SPX. The bottom chart here is the daily. The upper chart is the weekly. Longer term. And what we want to focus on right now, ladies and gentlemen, is taking a look at these two charts. The weekly chart has stayed bullish through this entire rotation from the end of 2021 all the way through 2022 into 2023, still bullish. Green, 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 all bullish. The daily has rolled around, and this is something that we use a dual time cycle for this rotational modeling system. You can see the peak back up here was bullish, rolled into neutral, bearish territory briefly here, went back bullish here, went bearish here, bullish briefly here, and has stayed bearish through this entire time from, August, September, all the way through now. We're getting these little yellow diamonds. These little yellow diamonds are warnings that the market is topping and or nearing a reversal. So understand that when we start to get these little diamonds right here, we're starting to get a near reversal area, meaning that we could see this flip into bullish territory. Now, the key that I want you to understand, and I'm going to flip to the SPY chart, which is the primary chart that we use, is that we are still bullish here as well. Bullish is indicated by these yellow dashed lines and predominantly green colors. Bearish is indicated by these magenta lines here that indicate we've changed direction. And of course, we would get red, flipping it into bearish. But understand that the markets have flattened out. So when we take a look at this on a weekly basis, you can see here that we have moved into this flat sideways channel. And what I want you to be aware of moving forward throughout 2023 is that we have, let me do it another way, we have a range roughly just above these COVID highs over here. So hypothetically from about here to about here, that we may stay in. This is the range that I want you to be aware of, that is highly likely to present some real range-bound trading for the U.S. markets. And when I say this, a lot of people are talking about how, this sets up an extended peaking pattern. Everybody shows you that pattern that we are here. And it shows, a huge, I'll try to draw it over here. It shows a huge rally and then a rollover and then some sideways trending and then rolls down. Okay. And everybody points, we are here. Look, we are right at this point right here. I don't know why you're getting bullish. I don't know why you aren't, prepared for doom and gloom and craziness. Well, what a lot of people don't understand is the entire upward cycle, lasting in some cases many, many decades, is full of miniature patterns like this. This type of pattern, I'll redraw it. It's called an excess phase peak pattern. It goes up to a peak, rolls over, stalls, flags out, and then at this point, this is the flag. So we have, and I've covered this before, this is a flag formation like this. And at this point, let me change this color. So we have something a little different. And at this point, one of two things is going to happen. Is either A, it is going to break down, break below this support level right here, and move into that deeper congestion period, or it's going to roll back to the upside, establish new highs, and continue to trend higher. So there's two outcomes here. There's an A, which is, let's call it the downward breakdown, or the B, which is the upward advance. And I have to say, historically, under major crisis events, we have a probably a 75 or 80% likelihood of a major breakdown event taking place. Those are normally associated with, for example, terrorist attack, economic disruptions, wars, or last time something major happened was COVID back over here, and I'm talking about a fairly deep collapse, or the global financial crisis. But in reality, we get these patterns repetitively in an uptrend. I mean, literally every couple of weeks or couple of months. If I go down to a weekly or an hourly or a 2-hour chart, we are going to get these every couple of days. And they typically will resolve to the upside. Now, there's actually 4 structures to this pattern. So let me do this. Drag this way over here. And there's 4 structures to this pattern. So you have the big rally phase, and then you have the blow-off phase here. Then you have the flagging formation. Then from here, you have 2 modes. You're either going to break below the flag, establish an intermediate low, and then sideways trend for a while before coming down and attempting to either retest this level here. And so this is essentially, let me find the text. This is A, the first setup. This is B, the flagging formation. This is the breakdown of the flagging formation, C. This is the establishment of the secondary support level. And then depending on what happens here, we either have E to the downside, or we have a new uptrend. And this is the component of the excess phase peak pattern that occurs. So let me, again, excuse me, it's fairly early in the morning. Try to recolor these. So this is the setup. So we really have the A, B, C structure. This is the pullback. This is the flag. So here we create the flagging formation, which occurs as a uptrend, and that's where everybody's pointing to. We are here. We are here. And then after this, if the excess phase peak pattern plays out, we will roll below this support level and then attempt to find D, a new support level here. Oops. Trying to draw with my mouse. And at this point, we enter into a sideways consolidation phase, which could last many months or many years before we attempt to either retest this level. And at this point, the market's either going to go up and reestablish an uptrend, or down and move downward. Same thing here. Once it comes up here and breaks this flag, it comes down into this area where it attempts to reestablish this flag formation. It's either going to go up and try to reestablish an uptrend, or down and set up wave D. So in this uptrend, every single one of these moves to the upside is consistent with this flagging formation. You get down into it, every single one of these peaks and rotations will be an excess phase peak pattern, generally. Some of them take, a couple of days to set up. Some of them take a couple of weeks to set up. But the entire upswing is all of this moving to this, flagging out, maybe moving higher from here, maybe moving higher from here, maybe moving higher from here. But the entire uptrend is this in this exact same pattern, setting up, executing this A, B, C formation, and then determining at either this C formation or B formation to move higher, or from this D formation to attempt to move higher. So this entire upswing, when someone tells me, oh, we're right here, look out, we're at the beginning of a massive collapse, I kind of laugh about the fact that, yeah, okay, the entire 200, 300% rally over the last 35 years in the market has been, we are here, be cautious, the market's going to crash. Yes, it could crash. There has to be some sort of a catalyst event. But if there is no catalyst event, if there is no massive crisis, then we are likely going to resolve to the upside. And what I'm trying to warn you is that, and I will do this by getting rid of these guys. That can stay. This can go away. That can go away. That can go away. That can go away. That can go away. So what happens is, what I'm trying to warn you is, we're right here at this point, and this can either resolve to the upside, and what we have here is, if we resolve to the upside, we are going to have to break above this high to start moving into new all-time high territory. This is the high of December 2021, hypothetically back on the chart. I'm going to show you over here. But in reality, if this flagging formation sets up and we enter into kind of a consolidation phase, we could stay in this range, hypothetically. Think of this as the October lows, 2022. This is the December highs, 2021. The recent all-time highs. This is the flagging formation that we're in right now. We could stay in this sideways mode, trying to find some move for the next 12, 14, 15 months. And particularly, I think this is going to be important because we have a lot of new information. For example, we have the Biden classified documents. We have the debt ceiling limit. We have issues in Congress and the House. We have investigations. We have foreign crisis kind of inching upward, particularly the Japanese credit market and banking market, which could tie into Asia. So we have a number of these events that are starting to build, which could keep us in a sideways range over the next 12, 14, 15 months. Maybe not prompting a new all-time high in the U.S. market until 2024, 2025, or maybe a bit later. My guess is that 2024, 2025, or end of 2023 may see us try to get to just above these previous highs and then stall back out. But I need to highlight this because it's too, if you listen to the fear mongers out there, you're going to basically hear, oh my God, we are here. Oh my God, you don't understand. The world is coming to an end. Don't fight the Fed. Well, you know what? I'm here to tell you that we have to let the dust settle. Okay. Yes, there is probably a 25, 30% chance we could see a downside resolution right now. There's probably a 50 to 65% chance we'll see an upside resolution. There's maybe a 10 or 20% chance of unknown is just going to go sideways for another 6, 8, 10, 12 months. But we need to play what's in front of us, okay? We need to understand the market dynamics at play. We need to stay properly hedged. And even if we get a bullish trigger down here, we would move into a near 100% position in our SPY trade, but we would still be hedging with metals. Metals have been moving substantially higher. They are an effective hedge. People had discounted metals many, many months ago, and now you cannot argue with the fact that gold set up a major bottom and has been rallying higher. And it's a matter of time before, in my opinion, gold is up above 2,600, and that could send a lot of people thinking, oh my gosh, where was I? I didn't even see this coming. So here's the scenario. We're looking at a potential wave 4 end here. This would be a wave 4 correction, beginning wave 5 to the upside. We could stay in this channel going forward for the next 8, 10, 12 plus months, just slowly migrating higher, churning, rotation, potentially coming back down and reestablishing this. It would not be uncommon to see the markets attempt to break upward, move into an upward trend, roll back down into a bearish trend. That would prompt the lower rotational modeling system back into bearish, and then moving back up to the upside, and then rolling back down, and then eventually resolving to the upside potentially. Okay, so we need to be aware that the next 12 months is very likely to be somewhat uncertain. There's going to be a lot of, let's call it fear porn out there, where everybody's going to try to convince you the markets are collapsing or the markets are whatever. Pay attention. It's very likely that it's going to require another 6 to 12 months to settle, earnings and global economic expectations to settle before we move into a solid breakout type of trend. And this is what I'm calling a revaluation period. I've been calling for this for the last 2.5, 3 years. This is a real revaluation period after we've had huge rally phases here. If you take a look at this and you really understand what's going on, you'll see that the 2000 through 2005 time frame, this period here, is really a revaluation cycle phase. So we reached our peak, we rolled downward. It took, well, how many years here? 6 years to get back up to the all-time highs again. And then we rolled back downward, took another 6, 7 years to get back to all-time highs again. We could be kind of looking at the same thing here, where it may take 2 years or longer to try to get back up near these all-time highs. A reversion trade back up into these middle areas where I'm pointing over here on the right is likely, but a big rally trend, probably not till 2020, late 2024, 25, or 26. Okay, so now let's come over here and let's get rid of that. And let's go ahead and come back over to these charts. The rotational modeling system is, I'm going to resize this. Sorry, I should have set this up ahead of time. The rotational modeling system is unchanged. We are still 25% bullish based on the weekly chart. I just showed you that. 75% bearish based on the daily chart. That nets us into a 50% short position, 50% cash. We are still set up in the same scenario as last week. We have got 20% allocated towards stock trading, 55% cash, 25% metals. Metals are acting as our primary hedge right now. Bonds are in a bearish trend still based on my rotational modeling system. We may get into bonds in the future if it moves in our favor. We are seeing a little bit of a reflation trade to the upside, but we are properly protected and hedged. So we are avoiding risks at this point and relying on the rotational modeling system to continue to guide us going forward. The metals position looks very powerful. I don't know how to explain this. I've been telling you for more than 2 years that metals are setting up an incredible base and bottom. You have to understand that, you know, prior bases and bottoms have been down in the 1300, 1280 range, even lower. Go back before that, you're going to be looking at, you know, the 730, 690 area, and then we see a 500, 600, 700% increase in metals on a fear factor going through the global markets. We're now setting up a base around 1670, 1700, and that's huge. That's very, very big, because a 500, even a 400% move from, say, 1600 is going to put us in the 37, 3800, maybe 4000 range for gold. It's going to be a very explosive move to the upside, I think. So now let's come back way back over here and go through the charts. This is the accumulation phase index. We have seen exactly what I predicted. We had seen this base bottom setup. We had a end of year kind of a washout or capitulation low. It's beginning first couple of weeks of 2023. We're already seeing some support in the markets. Nice white candle moving away from support, consolidating into this downtrend. If we were to see the upward trend continue, I would expect this to consolidate downward. So understand that this would have to move downward to see this move higher. We could see this consolidate into a kind of a sideways trend through the first quarter, not really doing much, maybe reflating a bit, but staying a bit sideways. You can see we've already seen this upward move here. We would need to see this move substantially down, break to the downside, which is this indicator here, to try to show us that the reflation trade is building a lot of momentum. We're not seeing that yet. So it's very early stage basing, bottoming. We're not seeing a lot of momentum. The custom fear index is down to 685. and we are seeing the markets move a bit lower. This is what we want to see. The market sentiment index is moving a bit higher. This is fantastic. We want to see this continue to move a bit higher overall. The custom real estate sentiment index is pulling back from these extreme all-time highs. I do believe real estate's going to have a day of reckoning, possibly a year or two of reckoning. It's just, this is extremely hostile territory up here. And this is a real big, you think of it as a cycle. So here we have the normal cycles. You can see they're staying in between this range and this range historically. And that's, 1.5 times standard deviation channels. Then we got into the low range here, standard range, got outside of it here pre-COVID. This was essentially the Fed dropping interest rates, creating a pre-COVID hype in the real estate markets. And this is essentially inverted. So this is hostile, very hostile at the end of 2018-19. Then the Fed dropped interest rates considerably. COVID hit. Everything shifted into extreme optimism. Everybody was buying real estate. You couldn't go wrong. Prices were going up 15, 18% a year. Now we've moved into extreme hostile territory. So this is almost like I don't want to call it a bomb, but think of it as a very large rock landed in a pond and set a large series of waves going off. If my interpretation is correct, this extreme hostile environment here is going to roll back down into a moderate optimistic wave, maybe over 4 or 5 years, and then it's going to start to settle back out. So we could see a 4, 5, 6, 7-year cycle of moderate deflation in real estate prices, where it could be very similar to 2003, 4, 5, or sorry, 1990, 3, 4, 5, and 2002, 3, where real estate moved down, prices moved down, consolidated, and moved more towards this center line, this center lower level. Kind of hard to see here because I don't have it, but moving more towards this kind of like this channel here or this channel here, where it consolidates in moderately hostile environment and then begins to slowly shift over 2 or 3 years into an opportunistic environment. And that could represent, ladies and gentlemen, a 10, 20, maybe 30% decrease in real estate prices over the next 5, 6 years. Next, we have the custom metals trend index skyrocketing. I mean, I don't know how to explain this to you. Metals have moved away from this consolidation phase. You can see from each of these bottoms, we typically get about a 450, let me do the math real quick, 7,000 to 11,000. So that would be about a 4,500 point move. And then from here, from let's call it 87 up to 13, that's approximately a 4,500 point move. So from here, we would be looking at about 9,700. So that would put us at just below 15,000 or around 15,000 on this index. Then we will consolidate possibly for a period of time and then attempt another move, which would put us potentially up into the 19,000 range. And I want you to be aware that we're in a very strong appreciation phase for metals. It's kind of a stealth move right now. It's going to become very evident. Metals are acting as a perfect hedge like they're supposed to. The next target for this is right around 15,000. That's another 2,500 points higher. We've just moved from this level, about 2,500 points on this index, about half the move. We have another half the move up to about 15,000. That'll put gold probably around 23, 24, 2,500, maybe a little higher, and silver probably up in the 28 to 33 range, maybe a little higher. Okay, next we have the, we've gone through these. Okay, real estate. The Realtor.com did not update the data this week. I don't know what's going on. They had some problems a couple weeks back, but long and short of it is the data is still the same from when I showed you. Reductions are higher, inventory count, active listings are higher, price levels are decreasing, median days on markets have elevated. The market's kind of moved into this stagnation. We need to see it really shift. I think it's going to shift with the last rate increase. We'll see how everything plays out. I think buyers, corporate buyers can buy whatever they want and sit on it because, if you have corporation profits and you can sit on, taking a loss for 2 or 3 years, it may not be that difficult. But I think most people have the real estate market wrong. I read an article today that said, oh, this is the greatest opportunity in your lifetime to be buying into real estate. I believe that's incorrect. I believe that we're going to go through over the next 7 to 10 years a restructuring of real estate valuations. We've never seen anything like this. It's almost like the big global financial crisis event or the speculative bubble that took place in .com bubble, or what we had after post-COVID. This entire phase of speculative buying right here, this 2018, 19, 20, 21 phase leading into early 22 was unprecedented. It pushed the markets into an extreme mode. And now we need to see another possibly 3 to 5 years of settling. And I believe that settling could be very disruptive for the real estate market. So pay attention. We're not out of the woods yet. I'll get you the updated data as soon as realtor.com posts it. We're seeing higher price reductions. We're seeing price trends stabilize near flat. Active listings are starting to accumulate. New listings counts, you can see they're moving much, much higher. We got a lot of property on the market, and the next phase is a series of price reductions. The heat rank is moving downward. The tightness rank is tightening back up to just about 0. Real estate inventory strength is rolling over, looking for the inventory strength to start to weaken. Same thing with the tightness rank moving downward. The real estate heat rank, I'm expecting to continue to move downward. And of course, seller desperation here. This is showing you that we're getting a little bit of a wave of buying at the end of last year. That could be corporations trying to buy into desperate real estate. But understand that I do expect this is going to change dramatically moving forward. Okay, next we have the volatility index. Just as I predicted, we have the end of the wave 5. We're at new highs at 11.43 or 34. Remember, I had counted this wave to you many, many times. A, B, C, D, breakout to the upside. Now we've seen this breakout. I expect it to consolidate around 10 to 12, not showing any big increase. We could get 12.6, 12.7, maybe 13.2 up in this area. But I think it's just going to consolidate in this phase until we get away from the debt ceiling and other issues. And so I don't believe we're going to see any big rally phase. I don't think this is going to be like a rip your face off rally or a massive upward trend. I think it's going to consolidate upward, biased with some volatility over the next 5, 6, 10 months, and then possibly start to move into a more consolidated upward trend. Okay, so there we go. We've got our updates together. The real opportunity here, as I showed you earlier, is to consider this range, roughly from here to here, maybe a little lower. This range here, and that's 440 on the SPY down to 346, 347. As the most likely consolidated range moving forward. Kind of just basically like this, maybe through the end of 2023 into 2024. That means we're going to have a lot of moderate rotation. We're going to have a lot of shorter term trends, and we're going to have some real opportunity. Now, to service us during this time frame, to provide opportunity, I have been kind of playing around with this. And I'll show it to you here. Maybe not all of it, but I have to shrink it down. But this is a new TT scanner running on a 30-minute. It's basically the same TT scanner code that you get with the TT scanner hot list, but it's running on a 30-minute chart, trying to provide opportunity for shorter intraday. This would be anywhere from 5 hours to 10 days in length. You can see some of these are 63, 80 half-hour bars in length. So understand that that would be approximately on a regular trading session, which this is based on, that would be approximately 4 or 5 days, maybe a little longer. But you can see here we're getting 7, 9, 5, 10% on some of these longer-term swing trades. And the strength of the TT scanner is that it gets into a trade, it sets a stop level, and then it'll get out of a trade. If it's wrong or if it moves against us, it'll get out of the trade fairly quickly. So this gives us a lot of trading opportunity that I may make available to traders through some special service. It is a great opportunity for traders to be able to trade intermediate trends with proper allocation, and not necessarily sit and wait for daily or weekly trends to set up, because daily or weekly trends may not confirm effectively. But again, working on tools for you guys to stay ahead of the market and to continue to find opportunity. This may give you a way to trade options or to trade smaller percentages and still potentially try to target a 0.5% to 2% a month return on investment on some of these trades, because the market is still moving. We're still getting 1.5–2% volatility in the indexes, but the markets are consolidating in a sideways range right now, not really moving aggressively upward or downward. Okay, guys, well, as we move into 2023, let's get ready and be prepared for what's coming next. Remember, this is not the time to go all in on any big trades. This is not the time to try to, get biased one way or the other. Certainly not the time to short the heck out of anything, although there is still that 25–30% risk that it could happen. Right now, we need to see how this plays out. Let the dust settle. It looks like we're going to be floating through maybe February, March, April before the dust actually settles. And that means we've got to continue to be on guard, watch for risks, let the market settle, prepare for what looks like a reflation trade, and then decide how we're going to move forward. Remember, this is really kind of the move here. Kind of back up into this area, maybe a little higher, stalling out, rolling over in kind of a sideways channel. We may get some fairly big volatility here, but in reality, I think we're kind of going to be looking at a reflation trade. And again, this is, from current recent lows up to here, hypothetically 45 point upside move in the SPY, which given where we're at would be about a 8 to 10% move upside, followed by potentially a 8 to 12, maybe 15% downside move. So you can see the range here, just playing with ranges. If it were to do something kind of like this, you can see there's good room for you to trade this range, but understand it could be sideways tight, range bound, and you have to be aware that we're not likely going to move back into this type of a move unless the Fed actually shifts dramatically or some crisis event takes place. And if some crisis event were to take place, we would literally be looking at a downside move, a quick little bottom potentially, and then a reflation trade, because the Fed would likely move into some extreme easing potential. In reality, this mid-COVID level and then all the way back down to the 2015-16 levels back over here, these are extreme downside target levels. So, I mean, if you take a look here, this is, I've drawn this many times, but this is really the intermediate support level. If anything were to break, I would expect this pre-COVID high, the mid-COVID range, and then all the way back down here to this 2015-16 level to become intermediate support for a downside move. So we have a fairly contained downside move unless the crisis event is U.S. based. If there's something in the U.S., if it's U.S. banking, U.S. credit, U.S. housing, anything of this nature where it's tied to a disruption that is core to the U.S. market and or global markets, then we could see a bigger, broader breakdown, maybe another 30, 40, 50% in the U.S. markets. But if it's foreign market, if it's the Bank of Japan, Bank of Canada, Bank of Mexico, Bank of whoever, if it's that type of a scenario where it's isolated foreign market, then we may not see that much of a disruption in the U.S. market at all. Understand that the U.S. market is the biggest economy on the planet. If it was U.S. based, it's kind of like, think of it as you have one tree in the forest that's the host of all the other trees. The other trees can kind of survive on their own, but if the host tree dies, it's going to be you might lose 60-70% of all the other trees in the forest. So long and short of it, the U.S. is the host tree, the host economy of the planet. If the U.S. economy takes a tumble, then you're going to see a 60 or 70% spill out through the rest of the global economy. Whereas if a little, I don't want to call it little, but if an isolated couple of trees in the forest get into trouble, call it, Peru or whatever, long and short of it, if they run into trouble and it doesn't really affect the host tree, you can have trouble with isolated foreign markets without actually affecting the U.S. market too much. But if it affects the U.S. market by more than, say, 60-70%, then you have a contagion crisis where you're essentially the source of the well of the global economy is now having trouble. That means that the outlying springs are now having trouble as well. Okay, guys, that's it for now. Trying to keep these shorter, not doing a good job, but at least I'm explaining what I've got going on and what to expect. Okay, share again with your friends. Share what's going on. Really, I'm trying to help you manage and execute well so that you can profit from my analysis and what's going on. If you're paying attention, remember, don't listen to the perma bears and the crazies out there thinking that, X and Y and Z are taking place. We've been calling this very, very well for the past 2.5 years. I have. And the reality is I'm giving you my best advice and trying to prepare you long term. Okay? Talk to you soon. Bye.